December 2025 might go down as the most confusing month in crypto history. Prices weren't exploding, but they weren't crashing either. Bitcoin just chopped sideways while fear stayed high. At the same time, institutions were flooding in, regulators were finally getting clear, and liquidity was somehow tightening and easing at once. On screen, Bitcoin chops between $85,000 and $94,000, while headlines flash: banks, ETFs, regulation, the Fed. Nothing made intuitive sense if you were only watching price. Bitcoin didn't crash in December. It bled, slowly, painfully, and mentally exhausting. Holiday liquidity was thin, which exaggerated every move, and liquidation engines were running hot, with multiple days clearing over $650 million in forced liquidations. Yet despite all of that, Bitcoin refused to break structurally lower. This is where context matters. Chop does not equal bearish in the long term. In late December, you also had heavy tax loss selling. Investors who bought earlier in the year were locking in losses for tax purposes, creating artificial sell pressure that disappears in January. Hash rate continued to hit all-time highs, meaning the most capital-intensive players in the ecosystem were still deploying resources aggressively. Seller exhaustion was flashing across multiple on-chain indicators. While retail stared at the chart, institutions were. This is the most important part of December 2025, and almost no one noticed it in real time. Traditional finance wasn't speculating on candles, they were laying pipes. Vanguard, historically one of the most conservative asset managers in the world, opened the door to crypto ETFs. BlackRock expanded its BUIDL tokenized fund onto the BNB chain, signaling that multi-chain tokenization is no longer theoretical. Franklin Templeton expanded exposure beyond Bitcoin and Ethereum, while Goldman Sachs made a $2 billion move by acquiring Innovator Capital. JP Morgan, PNC, and Bank of America all rolled out or expanded crypto-related services, and Charles Schwab added Solana futures. These are not retail FOMO trades. This is infrastructure being installed. Custody, settlement, compliance rails. When institutions move, they don't chase price. They prepare for volume that hasn't arrived yet. December looked boring on a chart because the real action wasn't happening on exchanges. It was happening in boardrooms and legal frameworks. ETF data confused almost everyone. Bitcoin ETFs showed mixed or flat flows, which fueled the narrative that institutional interest was fading. At the same time, Ethereum ETFs were pulling in strong inflows. XRP ETFs quietly crossed $1 billion in assets under management, and Solana ETFs continued advancing outside the US. The contradiction disappears when you understand positioning. Bitcoin ETFs paused not because institutions are bearish, but because they were already heavily allocated earlier in the year. Ethereum, on the other hand, is being positioned as yield-bearing infrastructure through the staking ETF narrative. That's a very different pitch. As for altcoin ETFs, approval does not equal an alt season. Capital flows selectively. Institutions buy what fits mandates, not what trends on social media. Macro conditions were just as strange. The Federal Reserve halted quantitative tightening, which on paper sounds bullish, but liquidity didn't immediately flood markets. Instead, the system got breathing room. Repo markets saw billions in injections, quietly stabilizing short-term funding stress. Rate cut probabilities for early 2026 began creeping higher, with March approaching a coin flip. At the same time, the Bank of Japan raised rates, reintroducing yen carry trade risk into global markets. The takeaway is simple but subtle. Liquidity didn't arrive. The valve opened. That's a massive difference.
Regulation also crossed a psychological threshold in December. The UK formally declared crypto legal property. US banks were granted broader authority to engage with Bitcoin and crypto services. The SEC approved a DTCC blockchain pilot, signaling that market infrastructure itself is moving on-chain. Stablecoin frameworks accelerated globally, with roughly 70% of major jurisdictions advancing legislation, and the digital euro was finalized. At the same time, enforcement didn't disappear. Do Kwon received a 15-year sentence. Leveraged ETFs were blocked. The U.S. Senate delayed broader market structure bills. This isn't regulatory hostility, it's regulatory maturity. The question is no longer whether crypto will be regulated, but how fast and how consistently. Ethereum and Solana tell a similar story of strength beneath surface-level skepticism. Ethereum's Fusaka upgrade pushed efficiency forward. Gas fees hit their lowest levels since 2017, and tokenization momentum accelerated across real-world assets. At the same time, leverage reached record levels, which is a warning sign, not a victory lap. Staking ETFs remain on the horizon, reshaping how ETH is valued. Solana survived one of the largest DDoS attacks in crypto history, added futures through Charles Schwab, and continued to attract developers for speed and cost advantages. It still faces competition from modular and Layer 2 ecosystems, but survival under stress matters more than narrative hype. Despite all of this progress, there was no broad alt season. Capital rotated selectively into infrastructure, protocols, and regulatory-friendly assets. Memes underperformed. Speculation gave way to construction. The system was tested repeatedly throughout 2025. Over $3 billion in crypto was stolen. North Korea-linked actors accounted for roughly $2 billion in hacks. DeFi survived a major stress test in November. Solana survived sustained network attacks. Bitcoin's hash rate pushed to all-time highs despite price stagnation. That's not fragility, that's anti-fragility.
So what did December 2025 really mean? Price disappointed almost everyone. Fundamentals strengthened across the board. Institutions committed capital, time, and reputation. The market may be transitioning away from clean, retail-driven boom-bust cycles toward longer, messier accumulation phases. A 2026 setup began forming quietly, without fireworks. Retail watches price, institutions watch plumbing. Looking ahead to 2026, the bull case is clear. Liquidity conditions are easing, ETF products are expanding, tokenization of real-world assets is accelerating, regulatory clarity is no longer theoretical. But risks remain. Macro shocks, excessive leverage, geopolitical stress, and delayed rate cuts could easily disrupt the timeline. So here's the real question, and it's the only one that matters. Was December 2025 distribution or accumulation?